Pets at Home cut its annual dividend by 43% on 27th May, from 13 pence per share down to 7.4 pence. Pre-tax profit fell 28% for the year. Free cash flow dropped 26%. Revenue was down 1% overall. On the surface, that reads like a company in genuine financial difficulty, and 43% is not a modest trim. But here is the number that changes the reading entirely. Cash from operations at Pets at Home was £191 million. The total cost of paying the old dividend would have been £59 million. The board had more than 3 times the cash required to hold the line and chose not to. That is not a distressed dividend cut. That is a deliberate strategic decision dressed in the language of prudence. The company's new CEO, James Bailey, previously the boss of Waitrose, framed it as a rebasing to 50% of earnings per share. The intention going forward is to grow the dividend from this lower base as earnings recover. That is a credible narrative if earnings do recover. It is a more uncomfortable one if this year's 28% profit decline turns out to be the beginning of a longer reset rather than the bottom of a cycle. The underlying pressures are real enough. The lockdown pet boom brought an estimated 3.2 million new pets into UK households between 2020 and 2022. Those animals are now aging, which means higher veterinary costs and lower discretionary spend on accessories and premium food. The market, as the company itself described it, was subdued. The vet division grew within the group, but retail struggled. Volume growth of 3.7% in food was achieved by price cuts on more than 1,000 products, a tactic that supports footfall but compresses margin. What makes the dividend decision worth examining closely is not the quantum of the cut, but the signal it sends about management's internal assessment of the next 12 to 18 months. Boards that cut dividends they can afford to pay are usually telling investors one of two things. Either they see capital requirements ahead that are not yet visible in the public accounts, or they are resetting expectations after a period in which the market had priced in more than the business could reliably deliver. In Pets at Home's case, the evidence points toward the latter. The turnaround plan is genuine. The question is whether the cost of executing it, price investment, service improvement, repositioning away from the lockdown-era premium framing, will absorb more cash than the current guidance suggests. For income investors, the practical consequence is straightforward. A yield that looked attractive at 13 pence is now 7.4 pence. Whether the new base proves more durable than the old one depends entirely on whether Bailey's Waitrose-style recovery playbook translates to a pet supplies retailer facing a structurally different consumer backdrop than the one that supported the business through 2021 and 2022.
Hollywood Bowl was the only FTSE 250 constituent to post a double-digit gain on 27th May, closing up 16.5% at 302 pence. The company released half-year results covering the 6 months to end of March. Like-for-like sales grew 2.3% in the UK and 2.6% overall. Spend per game rose 7.6% in the UK and 9.7% in Canada. The board announced a £5 million share buyback for the second house and a 10% dividend increase. Those are decent but not extraordinary numbers. They are not the kind of results that normally produce a 16.5% single-day move in a stock. The explanation lies not in what the results showed, but in what the market had priced in before they arrived. Hollywood Bowl's shares had fallen 28% in the 12 months before this announcement. A forward price-to-earnings ratio of around 13 times and a dividend yield of approximately 5% were already in the stock, but so was a significant degree of pessimism about whether the business could hold its margins and sustain its expansion plans against a backdrop of rising employment costs. CEO Stephen Burns was explicit about this. Labor's increases to national insurance contributions and the national living wage represent what he called an incredibly painful burden, with business rates alone adding £1.5 million to the cost base in a single year. That candor matters. Burns did not attempt to minimize the cost pressure. He quantified it. And yet the results showed the business absorbing that pressure while still growing revenue, growing profit, and returning cash to shareholders. For a market that had spent 12 months pricing in the worst, seeing evidence that the company was managing through, rather than being overwhelmed by, the labor tax cycle, was sufficient to drive a re-rating. The business model itself carries a few features worth noting for context. Hollywood Bowl's dynamic pricing system allows the company to vary prices within approximately £1 of a set rate, which provides modest but real flexibility to manage demand and revenue per lane. The estate currently runs to 93 centers, with a target of 130 by 2035, including 35 in Canada by 2032. The company has a noted defensive quality in poor weather. Its own description is that rain is good, sun is bad, since the centers are indoor leisure destinations. That characteristic becomes relevant in a UK summer that may be disrupted by ongoing macroeconomic uncertainty. The 16.5% move is not a signal that Hollywood Bowl is suddenly a transformed business. It is a signal about how much damage excessive pessimism can do to a stock price, and how quickly that damage unwinds when results clear even a modestly low bar. At 302 pence and a forward PE of around 13 times with a 5% yield, the stock is now priced for a more neutral outlook. Whether the next 12 months justify that re-rating depends primarily on whether the cost headwinds have peaked or whether a further round of minimum wage and NI adjustments is still to come.
Taylor Wimpey is the second most bought stock among UK retail investors on AJ Bell's platform in the current period, behind only Lloyd's. The stock is down nearly 25% in 2026 alone and has fallen more than 50% from its May 2021 peak. It trades at a price-to-earnings ratio of around 12 times, with a dividend yield of 8.7%. That combination, a high yield, a low multiple, and a substantial recent decline, is precisely the type of opportunity that draws retail investors into a name. The housing shortage in the United Kingdom is not in dispute. Planning reform under the current government has been presented as a structural tailwind for volume house builders. Taylor Wimpey carries a net cash balance sheet and a strong land bank. On a purely mechanical reading, the thesis is coherent. The complications are also coherent, and they are worth stating clearly. The dividend yield of 8.7% is based on a payout that analysts believe may not be fully covered by earnings in 2026. A dividend that exceeds earnings per share is by definition being funded from sources other than current year profit, which may be acceptable for a single year but is not a sustainable position. If earnings do not recover in 2027, the dividend becomes a question rather than a certainty. The second complication is the geopolitical overlay. The Iran-US tensions that have already disturbed Rolls-Royce's civil aerospace revenue outlook carry a secondary effect for house builders. Higher energy prices push up construction materials costs. If persistent inflation forces the Bank of England to maintain or raise interest rates beyond current market expectations, mortgage affordability deteriorates, transaction volumes fall, and the volume house builders' operating leverage works in reverse. Taylor Wimpey is not uniquely exposed to this risk. All UK volume house builders share it. But at a stock already down 50% over 5 years, there is limited margin for error. Short sellers are also active in the name. The presence of both retail buyers and active short positions in the same stock at the same time is the clearest expression of genuine disagreement about value, rather than momentum trading on either side. Retail investors see a yield and a discount to intrinsic value driven by a once-in-a-generation housing need. Short sellers see a dividend at risk, a macro environment that punishes rate-sensitive sectors, and a stock that has already demonstrated a capacity for multi-year underperformance. What the data cannot resolve is which reading proves correct. What it does establish is that the divergence is real, it is substantial, and the outcome will be determined primarily by where UK interest rates sit in 18 months' time, and whether the planning reform tailwind translates into completions at a pace that justifies the current land bank valuation. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.